Hello and welcome to the Unemployed Value Degen. Today I wanted to look at some of the effects of sector rotation for this quarter after the first 6 weeks of trading for the year. This is not financial advice, and I'm sitting down here today with one of my former students, Mitch. How are you doing today, Mitch?
Hey, Coach, I'm doing great. Thanks for having me.
All right, fantastic. Well, let's jump in, and as always, I just start out looking at the situation going on with the Treasuries. And it looks like we're finally getting this, finally getting the 10-year Treasury to start behaving itself and to stop freaking the market out. And let's see, I think it's gonna be something like that. Maybe I don't have the slope or the angle of this, but on the 10-year Treasury, which has now finally started falling a little bit, and it is far enough away from the past peak so people aren't freaking out about it. There's always something else to worry about. Now we're worried about tariffs. We're worried about what else is going on? There's what was the reason? So first there was DeepSeek, and then there was tariffs on Canada and Mexico, and then there was the inflation reports coming in hot. So there's always something to worry about in the market. But the good news is the 10-year Treasury is coming down.
Jobs data as well.
Oh yeah, so. Jobs data, and now there's new layoffs on top of that. So I dare say, I mean, I don't think there's really a consensus in the marketplace, but if I had to look and see what all the professionals are saying, the professionals seem to be worried about layoffs in Washington, D.C. Causing a recession. Is that the chatter that you're getting?
That's not necessarily what I've been hearing, but what I have been looking at and thinking is very interesting. Powell commented that the current levels of uncertainty in the market are making it harder for them to forecast what's going to happen with the economy. And I think that added uncertainty, and especially at the highest level, right, is just going to add more and more volatility to the market. I think that's the key characteristic of the Trump market is just insane volatility. Will it lead to a recession? I don't think so. I think everything is eventually going to get sorted out. There will be a little more clarity on how all of these policies are going to affect everything. Take a look at the 1 month chart on the 10-year. It's I think it tells a pretty interesting story, right? So it ran up to that peak at almost about 4.6 with Trump coming into office, and we've gotten some reprieve, right?
Yeah.
So you match that with what the market's been doing, right? The S&P, QQQ, they've been consolidating, but also nearing all-time highs.
I got to at least look at the 3 months.
It seems like it's volatile with a bullish bias.
Yeah. Now, I was looking at the VIX over the previous presidencies, and the narrative is that Trump is causing volatility. But the VIX for the 4 years of the Trump presidency sustained at a lower level. And I know there's COVID, so if you take out the first 2 years of the Biden presidency, the VIX was lower for the 4 years of the Trump presidency than even the last 2 years of the Biden presidency. So in the past, the first Trump term was low volatility. And I don't know if Trump 2.0 is going to be that much different from Trump 1.0. Can I get a VIX? Let me see if I can get a VIX chart just to show that. What's the best way to show the VIX? Maybe this one. We got 10 years. So the 2016 to 2020, the VIX sustained at a lower level than even just the last 2 years of the Biden presidency. And even now, even in these last few weeks, if we zoom in on this, it's still not so scary. I mean, we've only had, I think, 1 day in the last few months that the VIX even came close to 20. So I know the narrative is that Trump is causing volatility, but it's not volatility that people are willing to spend money on options to protect against.
Yeah, and I think it's really interesting data, and that's where the um, positive bullish bias starts to come in because yeah, there's volatility, but like you're seeing with the VIX, you're not seeing more put buying, right? So it's definitely interesting and kind of goes in with our thesis um, for the market to have a substantial return this year. And listen, the inflation that's most likely going to come with tariffs definitely is going to shake things up. But ultimately, as we've seen, that gets passed on to the consumers, right?
Yeah.
So I don't think the stock market necessarily needs to uh, have a recession.
Well, there's a lot of negative takes on inflation, and there's all these, armchair economists drawing their deadweight loss triangles. But they're not drawing a deadweight loss triangle for the income tax. And if the tariffs are dollar for dollar a transition away from the income tax and toward tariffs, I think there's probably a lot of positives from that. Now, if Trump is playing the same old game that politicians have played for decades, that it's actually a new tax and not a replacement of an old tax, then yeah, obviously that would, that would definitely crush the economy. I think all the Western countries are past peak governments and peak taxation, and every additional dollar of taxes has a huge detriment to the economy. But if it's just the transition away from income tax and towards tariffs, I don't know that all these doomers and negative Nancys out there that are really bearish on tariff consequences, I don't think they're taking into effect the change from income tax toward tariffs.
Yeah, I agree. Income tax is definitely going to be a big factor into how things shake out, but it just adds to the uncertainty right now. I think a lot of people don't know what to expect, and but you're seeing some movement underneath the surface.
Let me just I'm just pulled up the fear and greed index real quick because this is the just a shorter term on the market volatility of the VIX index. And you do have, so Trump came in was it January 20th? Although he won the election November 5th, give or take. We only had that one VIX spike above 20, and that was when the Federal Reserve kind of goosed the market with their hawkish rhetoric. But aside from that, I mean, if anything, you can see that the VIX moving average has been falling pretty much since the election. It has turned up a little bit positive there, but it just rebuts that narrative that the Trump volatility is bad for the market.
Yeah, I agree with you. Not all volatility is bad, maybe.
Yeah,
Sometimes that's where profits are made.
yeah. So let's sorry, I got to have my long-term view for interest rates. We're still in a global cutting cycle, and as soon as Trump was finished going after Canada and Mexico to shut down fentanyl across the borders, it seems like the new conversation is on two things. One is stopping Iranian oil exports, and the other is getting the 10-year Treasury down. So, for example, there's now rumors that Trump is going to go to these European countries and say, hey, we're tired of funding your defense. If you want us to keep our soldiers and to keep having NATO defend Europe, why don't you take your 10-year US Treasuries and swap them out for 100-year US Treasuries at a lower coupon rate? And that Trump is going to try and lower our interest payments and extend the maturity of the debt out significantly by essentially bullying Europe into agreeing to that swap. And any lower interest rate payments on the debt burden, I think would be. I think the 10-year Treasury could come down if either the Doge finds enough cutting to make the expense path of the federal government more stable, or if that interest expense comes down. And the other thing was Trump was threatening the BRICS countries 100% tariffs for every BRICS country that's trying to dethrone the dollar. So again, that's just using the bully pulpit to try and force people to buy treasuries, which could, I mean, I'm not going to comment on whether that's, ethical behavior or I like it or not, but I think that could get the 10-year Treasury to actually come down a bit, especially if Scott Bessent can do what Janet Yellen did, which is all new money issued to be done at the overnight rate, and the Federal Reserve just soaks that up anyway.
Yeah, I agree with your takes there. It's definitely a lot of threatening going on, and it'll be interesting to see, where the line is between making just trying to make a statement and get your way versus, actual economic, policies. So
Yeah.
it'll be interesting, but yeah, the rate definitely needs to come down because it's not sustainable where it is. So
Well,
we'll see if they're able to do that through Doge. I personally have some doubts, but I would love to be wrong.
yeah. Well, I've seen some estimates even before this that if you the amount of transfer payments and welfare payments going to illegal immigrants and then just taken up by fraud, that could be in the hundreds of billions annually. And if you take a couple hundred billion off of it, and a lot of naysayers saying, oh, they can't find anything in entitlements, that's non-discretionary. But if they find fraud or waste within the entitlements, they actually could affect it even without an act of Congress. And that hundreds of billions would add up pretty quick. And I just wanted to pull out the 10-year Treasury back a little farther. And by any historical terms, once you get out of the ZIRP, the zero interest rate climate, our Treasury bills are still low. I mean, throughout the entire 1990s, Treasuries were over 5%. Maybe the 80s are high, but to call 4.5% on the 10-year expensive, it's not by any historical measurement. So we're still, and this is what the liquidity measurements all come in, that these interest rates are still stimulative. I mean, this has the potential to blow a terrible bubble with this AI, artificial intelligence build out. So I think interest rates will come down over the next couple of years, but I'm not 100% sure that they should come down.
Yeah, I agree with especially that very last point. They might come down, but should they? Right? Especially with what we're seeing with inflation, we need relatively, not necessarily high rates, but we need rates that are substantial enough to keep inflation from running rampant.
Yeah.
And it's already, doing that.
Well, I didn't pull up the Trueflation measure, so there were a couple things that spooked the market, and one of them was the recent CPI numbers. But a lot of that could have been affected by, I think CPI generally comes in hot in January just by some readjustment effects. Trueflation has been, relatively subdued recently. I know it was, last time we showed this, it was up over 3%. But in the last month, it hasn't been so terrible. And there's a lot of speculation out there that the Federal Reserve, they say that their long-run inflation target is 2. And I think everybody knows that that number really now is 3, that they're targeting 3%. They're just not telling everyone they're targeting 3%. So, and if there's even some consequences on deporting the, 1 million or so illegal immigrants that have a prior conviction, 1 million fewer people would do a lot to lower rents. And rents are one of the biggest parts of the CPI. And on top of that, there was a bunch of multifamily properties that all got finished at about the same time. So I think we could have, for the next year or so, you could have CPI come in a little soft. And that would allow interest rates to fall. But then when interest rates fall, if we can get a 30-year mortgage at 5.5%, I think people will take out so much money out of home equity that that's going to be what really causes the next inflation spike. So I think if people are expecting inflation right now, I think they're wrong. I think the next big inflation spike might be coming, a year or two from now, when people finally can tap home equity because the 30-year mortgage is finally, if you get the 10-year Treasury down to about 3.5, and people can get which it was at in the middle of 2023, you get a 3.5% 10-year Treasury, and you get a 5.5% 30-year mortgage, and people can tap their home equity to go out buying jet skis and Winnebagos and things like that, then I think the inflation is just going to rip everybody's faces off.
Yeah, that definitely sounds like it could potentially happen. The all the untapped home equity is just waiting to be used,
Yeah.
and that's part of why we like FLA so much, right?
Yeah.
Because untapped home equity, that's one of the ways to use it right now.
Yep.
So yeah, I definitely could see that coming. There could be multiple waves of inflation, and it probably will just be just as volatile as everything else, going up and down. Um, it's hard to really say how everything is gonna move more so than just a month, a year from now, right?
Yeah.
So um, just a lot of uncertainty. I think that's been one of the biggest themes in the market right now, is just uncertainty.
Yeah. Well, I've got Finance of America companies, obviously, for the long run. But in the short term, I've been starting to build a small position in rocket companies for the home equity loan origination. I don't think we're going to have a big refinancing wave, because if you look at all the mortgages outstanding, the volume's been so low since interest rates have been high. Of course, people that have a 7% mortgage might refinance at 5.5%. But most mortgages out there are still at 3.5%. So I don't think you're going to have cash out refis like we had in the early 2000s. I think what you're going to have just is a home equity loan added on top of the existing mortgages. But yeah, let's go ahead and look at what's happening to the sectors. And after the sectors, I want to look at, so in my pinned post on Substack, I have a few different themes, and I want to see which themes are working and which themes are just dead in the water. And
yeah, I would.
Go
Okay,
ahead.
so year to date, that's where I wanted to start up.
Yeah.
Materials is really interesting to me. So it's the third top performer year to date, right? And we've got all sorts of pending tariffs going on. Trump has threatened copper, which that's on my radar for sure. He put out something for 25% on steel, 25% on aluminum. Um, I definitely think there's potential for domestic materials
Yeah.
to strongly outperform.
And so let me pull up these charts. So coming into the year, energy was the top performing sector up until about January 22nd, right? So energy was up 9.5% in the first 2 weeks of January, and I think that was mostly sector rotation, because it was so undervalued and people had done so much tax loss harvesting at the end of the year. But then it gave a lot of that back, and it's only at about 5% up for the year. But materials is beating it by a good chunk. And materials didn't have that huge purchase in the beginning of the year. So within the materials group, everything is going wild. But
yeah, gold at 2,900.
yeah, actually, that's probably a good place to look, is the some of these commodities, because you can do let's see. And I wanted to look at gold specifically because there was that Friday sell-off, but a lot of things sold off on Friday. So if I were to pull out this at a 5-year chart, what do you like better, 5-year or 1 year for the gold price?
For gold, I like the 1 year personally, but the 5 year, it tells the same story.
Yeah.
Gold follows inflation. Inflation's been running rampant, and so is gold.
Well, coming into the beginning of the year, I think it was the consensus that after the huge run-up, so I'll go back out to the 5-year. So after the huge run-up from all of 2023 and especially 2024, I think a lot of people coming into 2025 thought that gold was just going to chop sideways. And this move from 2,700 to 2,900, I think, surprised a lot of people. I'll go back to the 1 year. But just looking at this chart, if this is going to form, a cup and a handle, does this look like something that's going to chop sideways from here on out, or does this look like something that's going to keep running the rest of the year?
It's a good question. I think it definitely could have been forming a cup and handle with a bullish breakout around the 27,500 area. But it also has had a massive run up for something that's not a, you know, meme coin or something ridiculous. This is, gold we're talking about. That's essentially gone up $1,000 per ounce in a year.
Yeah, yeah, it was $1,950 February of 2024. So in 1 year, it's gone up 50%.
Yeah, and just along with uncertainty, I think people can feel certain about gold.
Yeah. Well, there's a lot of people been saying, well, nothing moves in a straight line. It has to give some back. And this run up just since the beginning of the year, it surprised a lot of people. But let me
Yeah, I wouldn't be surprised if it has some choppy movement. Maybe if it hits 3,000, then it pulls back for a bit because people love a psychological point, right? Once it
yeah.
hits 3,000, everyone wants to sell their gold. So who knows? I wouldn't be surprised with choppiness, but over the long term, over the next 10 years, I think gold will continue to rally.
Yeah. Well, what I'm looking at now is so that huge move in 1 year, gold moving from 2,000 an ounce to almost 3,000 an ounce. A lot of the gold miners have they had some hedges in place to protect their downside, but it also limited their upside. But those hedges, some of them are 1 year in duration, some are 2 years. But I think it's getting closer to the time when a lot of gold miners are just going to start swimming in cash flow. And
Yeah, I agree.
and the gold miners, at least the small ones, haven't budged. The prices still are pretty subdued. And now that they're, for example, some of the gold miners I follow, their all-in sustaining cost was $2,000 an ounce, and so they went from break even to having just massive cash flows now as soon as their collars wear off. So let me see if I can go to all the other commodities and just see what materials. Can I get a year to date on some of these? Yeah, I got a year to date on some of the materials. So copper is running, platinum is even up. It's not close to where the platinum miners are profitable yet. Silver is running, gold is running, steel is running, iron ore, titanium, lithium, steel. That's in the metals.
So with copper, I know you have a lot more names that you know a lot on than I do, but Hudbay Minerals is the main one that I've been watching, and I can't help but feel like the tariffs are going to hurt them, right? Canada, they sell a lot of their products in Canada. They they do have some domestic mining, but they also have in Europe, right? And that's who Trump is, potentially going to be targeting with tariffs next. So I
Yeah.
I don't know if I'm feeling the momentum on copper right now.
So uh, now they're both copper and I think silver right now. It's both industrial metals. And one of the strange divergences that took place in 2023 and 2024 is allegedly the economy was growing, but industry wasn't, right? Industry was struggling while the economy was growing because all the jobs were, government and admin. And I think the market might be sniffing out that under Trump, you might actually have manufacturing start up again. As far as the tariffs are concerned, now we saw with Canada and Mexico, the tariffs weren't meant to raise money. The tariffs are meant to get them to take the border seriously. And then surprise, surprise, Mexico puts 10,000 troops on the border. Canada puts 10,000 police on the border. And I think Canada had a bust of, I think, the largest fentanyl lab ever discovered. There was a bunch of people in the news saying, oh, Canada's not a big fentanyl player. It's huge, the manufacturing for fentanyl they have up there. But anyway, those tariffs are now paused as long as they deliver what Trump wanted, which was fentanyl. As far as Europe goes, so Trump did reciprocal tariffs, which means whatever your tariffs are on us, we'll put on you, which is kind of interesting because it means they can't retaliate and raise tariffs because then ours would automatically raise as well. And the big thing is, so Europe, their primary form of taxation is VAT, the value added tax. And it's highly suspicious that they apply the value added tax on American manufactured goods, because in the US they tax incomes. So if a company makes a product in the United States, they're taxed on the income they make when they sell it. And then when the product is sold in Europe, Europeans tax it on value added. So I think what's going to happen with Europe is they're going to have to make VAT exemptions for US goods, because we're taxing American companies for our tax base, and then they're taxing American companies for their tax base. It doesn't make any sense. So I don't know to what extent Europe will back down and allow VAT exemptions for American products. But I think that's primarily what Trump is going for. Because if you look at the value added tax, there's a huge discrepancy. So again, I don't know how much is actually going to get implemented versus how much the other countries are going to change their policies, but a lot of them make a lot of sense. Both copper and silver now, it's about industrial production picking up, and also steel. There was a really interesting data point that I wanted to show you, and I just have to find it. It'll take me just a minute. But what do you think?
I was thinking about steel lately as well. HCC reported earnings on the 13th, and the stock has tanked because they're dealing with more pressure from China. There's more supply over there. Coal prices have been weak, but they just they're going to have 2 new mines domestically coming online in 2025. So the chart, is bombed out, and they had really strong sales volume despite, the market. So it's something that I at least have my eye on. Yeah, look at completely bombed out. And I don't think its results were nearly, warranting this sort of drop.
Yeah, I mean, look, hard coking coal is a cyclical commodity, and it's in the cheap part of the cycle. And at some point it will be expensive again, because that's how cyclical commodities work. And as long as the companies you buy have a strong balance sheet, so they're not the ones that go bankrupt in the weak part of the cycle, then whether it's next year or 2 years or 3 years, at some point, the hard coking coal is going to be expensive again, and it'll be, by that time, probably $125 stock because of the new production coming online. But yeah, that's a cheap price for this company. Cheapest all year. How many years do you have to go back to get that price again? You have to go back to 2023 to be able to buy Warrior met coal at this price. And
the fundamentals have just been getting better on them. I feel like it's definitely a good long term to hold, but like you said, it's very cyclical.
Yeah.
So who knows if this will be the end of the downturn, but it looks to me like this could potentially be forming some sort of bottom.
It all depends if industrial production picks up. And I wanted to show you this chart because it was month-over-month changes in United States manufacturing. And what this really shows is that we've been in a manufacturing recession for 2 years. And this is what I was getting onto the Biden economy. They said, GDP is growing 3%, but that the commodities weren't responding because manufacturing was struggling this entire time. And the very last month, after the results of the election came in, and small businesses got a little more confident, we might be coming out of this manufacturing recession. So if we get a few positive...
It does also look like a very cyclical December on that chart. Some seasonality there, but I do agree with you.
Yeah.
And if you look back to 2023, it had that spike there as well.
Yeah, so there is that seasonality. So however they're adjusting seasonality, this December is always positive. But we'll have to see. I mean, this is a 2-year manufacturing recession, and I don't know for a fact that we're coming out of it. But when you have Trump saying that all permits are going to be approved for anybody who deploys $1 billion or something like that, are we going to be off to the races again? Because nobody really has a good consensus as to what part of the cycle we're in. And people are saying, we're getting late in the cycle. But this looks like a 2-year recession that we're coming out of. So that would tell me that we're early cycle.
That's very interesting. It does look like a 2-year recession that we've gone through. And with everything Trump is doing, he's setting up for a domestic industrial boom.
Yeah.
So I think that's a really good point.
So, and there's a lot of market participants that said, I hear it frequently. We're late in the cycle. You got to take money off the table. And I think that, if we are heading into the expansion of the boom times, I think the rally could rip everybody's faces off. And there's a lot of people clenched and ready for a crash, and a lot of people saying that Trump inherited a recession, and I think they might be completely off.
Yeah, and if he did inherit a recession, I think it's at least a little bit ways away. I'm not taking money off the table right now. I think the market has been seeming primed to continue ripping.
Yeah. So
it's just certain things under the surface are moving.
There's energy has been lagging behind materials and real estate. So on my themes, on my pinned post on Substack, I have the inflation protection strategy for gold, oil, and land. And real estate has been struggling under these interest rates. Energy had that bounce back in the beginning of the year, right? So it had this, I think this was tax loss harvesting and then rebuying at the lows. But since that time, it's been down for the last month. But gold has been the one rallying. So if I were to score my inflation protection themes, gold, oil, and land, only gold has really been working. Oil and land have not been. Do you think that continues? Sometimes your first 2 months of the stock market set the theme for the whole year. Do you think that that's going to be a pattern that continues? Is energy going to struggle all year, and are interest rates going to crush land all year, or are those things that's going to revert for some amount in the middle of 2025?
Yeah, it's a really good question. I think that real estate definitely could continue to struggle with high interest rates. I think that might persist, but I think energy, there's going to be a lot of positives going on for them. I've been seeing a lot more about, uranium's coming back. Natural gas has been doing better. I think gold might still outperform. I could definitely see that happening, but I wouldn't discount energy coming back and at least, performing in line with gold.
So this is natural gas, and the meteorologists are predicting another big polar vortex blast for, I think, hitting Tuesday and Wednesday. I think some parts of the U.S. it's already snowing. But yeah, that got natural gas. This cold winter got natural gas out of this $2 dead zone, and then let's see, crude oil.
Crude's been given some back, but
it gave some back. Now, there was an expression last year that people were saying that every day over 70 is a good day. And it's been staying over 70 for all of 2025. And the question is, where do we go from here?
Yeah, I think it's a good question. Supply doesn't seem to be an issue. I think it'll be a lot about, what the oil companies are doing as far as capex and increasing new production.
Yeah, so there's kind of a split right now with there's a lot of doomers out there saying that the Permian Basin is rolling over and that production is going to slow down, and people are saying that that's just a geologic reality. I think what happened is with the major acquisitions, I think Chevron did a major acquisition in the Permian, and they didn't cut production immediately because they didn't want to have layoffs immediately. But the Permian oil companies only kept about 5 years of inventory. They were drilling aggressively and only kept about 5 years of inventory. And after Chevron's acquisition, they consolidated their land parcels, but they want to have 20 years of inventory. So that means cutting the drilling program by 3/4. So Chevron announced, I think, a 20% layoffs of their global force. And a lot of that has to do with this acquisition in the Permian and then cutting the drilling program by 3/4. So I think oil production could slow down, not because it's a geologic reality like the doomers are saying, but just because that's what happens when you have a merger and acquisition wave. The super majors want to have 20 years of inventory or more. They want to be forever companies. And the companies that were building themselves up to be acquired, they want to prove, I have 100,000 barrels a day of production, so value me based on that. So the natural progression is after a merger and acquisition wave, production comes way down as the large acquirers want to have a longer inventory life than what they acquired.
Yeah, that makes a lot of sense. And yeah, I agree with you. So I don't know about if energy will necessarily outperform gold then. You might see more of the same. You might see, the first 2 months setting up how the rest of the year will play out. But I also saw some data points about the second half of February being, seasonally like one of the worst, 2 week stretches for the market, and this year was no exception.
Yeah, yeah. So I don't. There's a lot of seasonality charts going around. I even saw one that was years ending in five, and with that one, so I like the one about presidential cycles because it's plausible. The incoming president has a big spending program and then becomes a lame duck, and the months of the year I find plausible. I didn't find the seasonality for years ending in five to be very plausible because you can't
No,
really point to any sort of causal mechanism there for years ending in five. But and I
yeah, that's
don't
just a
know.
coincidence.
Yeah, February. I don't know if the market has to fall in February, but let me go to let's see. Let me go to the charts, and on Friday, because after my themes of gold, oil, and land, inflation protection, it's artificial intelligence, it's AI, and on Friday the Nasdaq made new all-time highs. Now the S&P 500 didn't, but the Nasdaq did. Which again is surprising because a lot of people, especially after the start of the year, big tech has had a hard time catching a bid. But
Some big tech, Meta's had like 20 days of green charts in a row. Something there definitely is starting to be some breakup in the Mag 7 performance.
yeah,
Is something that I've noticed. Yeah, look at that giant bright green,
yeah,
25.8%. Meta has absolutely just taken all, the air out of the Mag 7. Amazon's been doing okay. Microsoft's actually looking pretty cheap. I was looking at that stock. Apple's been chopping. Nvidia's coming down a bit. Um, yeah, it's really interesting to see what's been going on with that. And I think, as money comes out of the Mag 7, it's going to flow into hopefully, some more value names,
well,
right? IWM is still, pretty significantly below its all-time high, which considering what, SPY and QQQ are doing, there's room for value to run.
so I wanted to show you the big tech ETF, the Mags Round Hill Big Tech ETF, and it's not an ugly chart. It still looks like a bull flag, but it's way below new all-time highs. But the QQQ, the Nasdaq, just broke out to new all-time highs. So it's not big tech that's doing it. It
Right.
is da 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 small tech. Look at ARK.
Revenge of Cathie Wood.
Yeah. So one of my themes was the revenge of Cathie Wood, that small tech was going to outperform. And if you take it out for I don't know years, 5 years, it had just built this enormous base, and just in November with the Trump election, it broke out in a huge way. So this is not a new all-time high, obviously, but for the year. So big tech, and again, big tech doesn't look bad. It looks like a bull flag pattern, but it's small tech that's carrying the NASDAQ now.
Yeah, I agree. And I'm definitely very interested in small tech.
Yeah.
And with everything that's been going on with healthcare names, something we actually called out on one of the last few videos I was on, TeleDoc has been absolutely
Yeah.
ripping. And I think that's so crazy. And SoFi's been ripping. There's been a lot of good small tech names lately.
Yeah.
Uh, Definitely opportunity in the space. And yeah, if this is just the beginning of that breakout, that
It's just the
golden
beginning.
cross for the first time, if this has a pullback, that's something I would consider getting into. They just made a pretty important acquisition It's one to keep on the radar for sure. It fits the theme of healthcare that's not going to be, touched by RFK and small cap tech, integrating itself.
Yeah.
Um,
Normally, I believe in buying dips, but when you have a chart, when something got sold off so hard, and if we're in a falling interest rate environment, I mean, it might never catch the same multiples that it had in 2021. So it might not be a $320 stock, but it could easily become a $140 stock in a year or 2 years.
even
So
just looking at the range it traded in last time, it still could quite easily double to 30 from here. Yeah,
yeah,
not everything needs to be a 10x, right?
yeah,
This could be a easy double,
yeah.
and sometimes we're having just high conviction picks that can perform well.
So
It's
I
better
would
than
not be.
moonshots.
I mean, I know it's at the top end of the Bollinger Band, but it did just have the golden cross. I don't know if I would be the one waiting for dips to buy on this. I mean, maybe you know technicals better than I do, but these small cap tech names, you might not get dips in the good ones.
Yeah, 100%.
So let me go back and just go to, so speaking of value, because I'm a value degenerate, I want a rotation into value. The S&P 500 has not hit its previous all-time high yet, although it's getting close. It doesn't look bad. But look at the equal weight, which is going to match the value one. So the equal weight is much less clean and much farther away from previous all-time highs. And then look at the value factor. This is the same chart as the equal weight, but again, it's small tech. The rotation is from big tech into small tech. The rotation is not from tech into value at all.
Yeah, it's very interesting seeing the discrepancies, but I would really like to move on to consumer discretionary because I've noticed something interesting there.
Yeah. So let's
High end has been way outperforming the low end. Some of the top performers in consumer discretionary is Tapestry, which is like Coach bags and stuff. And you got Starbucks, you got Royal Caribbean, Ralph Lauren. Like it's a lot of these high end of the K-shaped economy companies
what's the
that
best way to show this? So Tapestry is your high end.
so
Ralph
wait, if you
Lauren.
go to the spider selector, yeah, go to the other one, the other tab you have.
This one.
Yeah, hit the drop down.
Okay, there we go. Let's see, and this is ranking it by
By year to
percent
date.
change. So Tapestry, Starbucks, Airbnb, Ralph Lauren, Caesars Entertainment, MGM, Royal Caribbean, Domino's Pizza, eBay, O'Reilly Automotive.
But go to the end and look at what's been getting crushed. Right? Yeah.
Deckers, Ulta Beauty, Las Vegas Sands, Tesla, NVR, General Motors, Lennar, Ross. See, I do see that you have some the K-shaped economy where the low end is getting crushed and the high end is thriving. Let's see, but it's not as clear cut as that. Sometimes it's really just
it's not black and white, right? But it's just a general theme that I've kind of been noticing in what's been performing well in this sector.
Now, the year to date, this is the worst performing sector. And I had put consumer discretionary as one of my themes. But I feel like consumer discretionary might have been early. Now, maybe the response to that is I just need to be a better stock picker and pick better individual names. But do you think as a sector that this is going to be good in 2025, or is the worst performing sector going to stay the worst performing sector?
Well, I think I'm always a contrarian, so I'm always looking to be buying where nobody else is looking, and it seems like that's consumer discretionary right now.
Yeah.
Everyone's fearful that inflation and tariffs are going to, eat up margins and hurt the consumer. But I think the high end is going to be fine.
Now, I'm usually the one who's catching falling knives, but my gut feeling is telling me to add more to small tech for these rallies. I mean, so small
I
tech
don't
is
disagree
working.
with you there. I think it's all about finding small tech that hasn't already had its rally.
Well, again, so we looked at the TDOC chart. Now, Open Door is too interest rate sensitive, but the other medical one is LifeMD, right? That one's been having a pretty decent rally. Let's see. NRDY might still be in
Oh,
that.
the nerdy chart looks great. I keep
Yeah.
seeing this chart and thinking I want to buy it. I haven't yet, but I mean the way that it had this rally and it's been consolidating above both of the moving averages. You got the golden cross. It's not overbought. This is looking so primed to take off.
Yeah. The staffing company, ZipRecruiter, maybe not as attractive
Yeah,
as some of the others.
I don't know how I feel about staffing right now. Um,
Well, there's going to be
I
some
think in
recently
general, just
unemployed
the
people.
I'm sorry, what you said?
Oh, there's going to be some recently unemployed people, maybe 15,000 IRS agents, but they have severance pay till October, so it could be early.
Yeah, it's an interesting one to keep on the radar, but I think that the job cuts probably is bad optics on recruiting companies.
Yeah. Let's see. I didn't start. I mean, there is a lot of small tech names that are just going crazy. And this one I didn't start a position, and I wrote about it, Gorilla Group, but that one's been going wild.
Oh my God, yeah.
Yeah, I think I wrote about it in this 15 range, and it's then doubled off of that. But not all tech. So the data center build out stocks have been struggling. So Applied Optoelectronics, I mean, it's still a bull flag, just like the Mag 7 ETF, but it's not grinding higher like a lot of the other small cap tech is doing. So right now, it seems like the rotation's out of the data center build out and towards other aspects of tech.
Yeah, I would agree with you there, but I think this chart is still showing some promise. It can, if it can get back above the 50-day, it could be back to the races. I mean, it's had some pretty strong consolidation in the last 2-3 months.
Yeah.
Downwards, yeah, but considering what's been going on with a lot of the rest of the industry, it's not to be unexpected. Is it necessarily where I'm looking to put my money at the most right now? Maybe not.
Yeah.
There's some other tech names I might prefer. Yeah, there's that tech industrial name I was telling you about for a little bit that had a big rally. Might have missed it on that one,
Oh,
unfortunately.
AIOT.
Yeah, might have missed it, but this was an interesting one.
Yeah, I'd have to
There's
check the
just like a whole lot of
fundamentals.
rallies. Like, I'm sorry.
I'll have to check the fundamentals. I did like it. I just didn't have time to write it up before the earnings call, and it bounced 40% on earnings.
Yeah, I mean, I couldn't have expected the earnings to be that great. Like even when I was looking at it and analyzing, but there's definitely some interesting names. If this was to take a pullback back towards the 50-day, it would be something I'd be interested in.
Yeah. All right. And then
Um,
the other top performing sector is financials.
oh my God, yeah, financials have been it's the banks, that like JP Morgan at all-time highs, Citibank's been ripping, uh, and the regional banks have been doing pretty well too. So I'm not sure. I haven't really dug deep enough into the banks because I typically prefer, non-bank financials.
Yeah,
But
I'm
I
not a
think M
huge
and A
fan of
is going to be
banks.
huge.
I'm not a huge fan of banks either. But if you check out, if I go to the world, so some, and we didn't talk about the dollar index today, which following interest rates, it has been giving some back. Although I've heard a lot of people say that they expect maybe some resistance and a bounce on let's see, call it, I won't do a channel, but maybe this line would provide some sort of, past resistance is future support. But until then, just that recent collapse in the dollar index, you've got a lot of international stocks really going wild. And especially Brazil has been leading. But a lot of countries, and also Europe has been doing very well. So looking back at the financials, I pulled up Burford Capital, but there's also PagSeguro. All the Brazilian financials that I wrote about have been starting to break out. Nubank, New Holdings, that one's recovered pretty aggressively. But it's all of them across the board. And part of it is Brazil, and part of it is just financials generally. So what other financials? Well, Jackson hasn't been moving too much. Let's see, Doug. So Douglas Elliman's been climbing up. Rocket companies. And a lot of this is on that little bit of interest rate relief. Do Abacus Life. Well, Abacus Life isn't really showing any signs of anything. And then Finance of America, I think, is still in its consolidation period after the run-up. So yeah. But Burford Capital, this was one that I think at the first of the year, I said, what are my two main themes? And I have a strong suspicion that Burford is going to settle their Argentina situation sometime, by the middle of the summer, give or take, or maybe late summer. And all of a sudden, after being stuck in a range for so long, it feels like Burford Capital is getting some attention and getting some traction. That maybe
this one's looking to break out. Could you go a little bit longer?
Yeah. Do a 3-year.
Oh, wow. So yeah, I could really be off to the races past like 16.5 or wherever that top is.
Yeah.
It's been consolidating in this range for like a year, it looks like, and breaking out pretty strong. I'm about to make a golden cross. It is getting a little overbought, but overbought can just get more overbought, as we've seen.
Yeah. Well, Burford Capital, before they did the U.S. listing, back when they were only London listed, because of its returns, because of its growth, and because of its ability to be uncorrelated with the market, it had a crazy multiple. And I have to pull up the London ticker because it doesn't show up in the history after it became U.S. listed. So I have to find its old ticker and look at the price chart there. So what is the LSE? Burford Capital Munich, Berlin. What's the ticker for Burford Capital LSE? Is it London Burford? I don't want the, Bur.L maybe. I'll look at that one. That's what I'm looking for. And then if I go back to the price chart, so keep in mind in 2018, it had a lot less revenue and it was almost double the current price. And if I look at Burford Capital, just price to sales compared to 2018, the multiples that this stock can fetch when people appreciate its growth, its degree of uncorrelation or negative correlation, and this thing can really go to absurd multiples. And now after 7 years of growth, it's a much, much bigger company. So this could, and you can't see this if you just look at the US ticker, because I think it went public sometime in, 2020, 2021 on the New York Stock Exchange. But I'm super bullish Burford Capital.
Yeah, they do a lot of that litigation financing, right?
Yeah, and they're the public market leader. And one thing that's nice, if you look at their minority shareholders, they sold 5% of the company here or there to some of the major law firms. So it's kind of like you guarantee your pipeline by making sure that your suppliers own a small piece of the company. They're just so clever in how they set everything up. And the founder is a finance guy. and I think he's been doing everything right, and he's always buying more in the open market, so the incentives are really aligned.
Yeah, this is looking like a really interesting play.
Yeah, and let me go back to and again, this is just so much of a bigger company than it was 7 years ago, and the multiples it could eventually fetch are just absurd if it gets some momentum to it. So yeah, let's go back to the sector. So out of all the themes that I put, industrials and reshoring, they've been kind of moving sideways, but again, I think we're probably heading into, and I'll just go back to this, I think we might be heading into a manufacturing industrial boom time, but the industrials haven't really responded yet. Materials have. It's kind of funny, materials are outperforming industrials, and that's not normally the pattern you'd think would happen.
So that might make you think now might be a good time to get into some industrials.
Yeah, that might be not too early. Whereas I think the consumer discretionary, at least the companies I like, they have been struggling so hard. And I like buying things when they're cheap, but maybe I need to focus more on buying things that are actually going up.
Yeah, I agree with you there. I think we might be early on discretionary still, even with acknowledging, the K-shaped trends. I I agree that I think the industrial material thesis might be the strongest one. The technology thesis I like, but got to find ones that haven't already had their rally.
I don't know. I think it's early days in the rally. I mean, I know I'm a value investor. I like buying things that are cheap on price to book. But and I know we're not going back to zero interest rates anymore, but even if we go back to a 3.5% 10-year, that's still highly stimulative for these financial conditions, right? So even at a 3.5% 10-year, I think that's still loose monetary policy, and I think that the tech companies, the small cap tech, when they get some momentum, they can be very bubblicious. So even though there's been some huge run-ups, and what's price to sales on TeleDoc compared to what it was historically? Actually, let me pull it up on macro trends.
Yeah, macro trends is good for visualizing that.
Yeah, so TeleDoc, check out the price to sales, what it did historically and where it is now, because sales have been growing, right? This is revenue per share, and that's been growing. It's at a price to sales of less than 1. And at the previous peak, it was at a price to sales of 20. And these tech stocks, when they go absurd, okay, maybe it doesn't get back to a price to sales of 20 again. Maybe it goes to a price to sales of 5. Out of the zero interest rate environment, maybe price to sales of 20 is off the table. But price to sales of 5.
Expected to get back to a 20, but a 5 to 10, maybe.
Yeah. So when you say, oh, I might wait for a pullback and a dip to, maybe not buy TeleDoc at 14 and maybe buy it at 12. But this is something
Might
that
not matter much if it goes back to 40 or 80.
Yeah, so I don't see this going to 30. I see it going to 50 to 80 to 120. And at that point, whether you buy it at 14 or buy it at 12, I think what I want to buy right now is I think the thesis that's working the best is the revenge of Cathie Wood and the small cap tech. And if I'm a year early and it falls back to 10 and I have to wait, then too bad. But if this is a train that I want to jump on, is I want to put the marginal dollar into small tech.
Yeah, I agree with you there, and I do like TeleDoc's positioning.
And then the rest is just finding more small tech names. I have a write-up on one that it's going to be released on Monday. That's MTLS. They're so they do the software for 3D printing. They call it additive manufacturing, and so they're kind of like the central hub and spoke with the software and the patents, but they also do some manufacturing themselves. And that's broken out since November pretty well.
Yeah, that sounds like some good positioning. I'll be interested to read your write-up.
Yeah, so I think what I want to really focus on, I know my Substack has been mostly commodities, materials, energy, but I own so much of that stuff and it's been performing so badly. I think my best take on what's going to work for the rest of the year is I think this is going to be the revenge of Cathie Wood. I think 2025, the data center build out stocks are going to chop sideways, and this is going to be the revenge of Cathie Wood as people look at, because there's so many companies. You look at the
Have you broken down the holdings of ARC yet, and sift through that?
I did, and I didn't find a lot that was super exciting to me, although I did a write-up on Schrodinger, which was using machine learning to do some drug discoveries. But compare the revenue. So this is the revenue of TDOC, and that's a chart of a growing company, and the growth is slowing, and that it's fair the growth is slowing, but they swapped out CEOs and they have a plan to reaccelerate growth. And compare this revenue chart with the stock price or the market cap. And that's what I'm looking for, is situations where the revenue and the stock price are just totally disjointed like that. And there's so many companies like this that are this revenge of Cathie Wood that look just like the chart for ARC. Because, okay, maybe it's not going to be a $45 billion market cap company, but it doesn't have to stay a $2 billion market cap company. It could be 15, it could be 20. Easily.
Yeah, I agree with you. It kind of reminds me of what we saw happen with Carvana.
Yeah.
Remember that one? It's trading at almost 300 today.
Yeah, Carvana remains my biggest mistake. Buying 4,000 shares at $3.92 and then selling covered calls at $5. I mean, that was a potentially a life-altering amount of money, and I think that might always be my biggest mistake.
Yeah, so far until the next one, right?
Yeah, well, at least on a relative basis compared to my net worth at the time, that might always be my biggest mistake. Hopefully I don't make a mistake bigger than that.
Yeah, I hope so as well. But
Right.
Always opportunities like that in the market.
Yeah.
Is, the optimistic point of view.
Well, I think I've been finding things pretty regularly that have the potential to become five baggers, finding things that have the potential to be a near-term 30 or 40 bagger is not really in the cards for a lot of companies. But
speaking of which, there's a company that I remember you thought could be, have that sort of potential. Cardlytics.
Yeah.
What's that been doing?
A whole lot of nothing.
Whole lot of nothing. Yeah.
Which is
Is that just management not making good on their their deals, because they had that American Express deal, right?
Yeah, so they have new contracts coming in. Let me go to CDLX. Now, Open Door, Cardlytics, and TDOC are in so this is the market capitalization. They're in the same category where if management executes well, they'll be amazing. Of the three, I mean, Open Door is the most interest rate sensitive. Cardlytics is the most management sensitive. Now, trailing 12-month revenue is not a terrible graph. I mean, it's not aggressive growth. It's been plateaued since 2022, which again, it's the narrative was we had 3% GDP growth, but almost every company I listen to on earnings calls, they don't have any growth. So I think the Biden economy, I think, was funny numbers. I think it's been a 2-year recession. And I see this in a lot of companies, but this is not that ugly of a revenue graph to compare to this stock price graph, right? Those graphs are still disjointed, but Cardlytics has a lot of efficiency problems. They have a lot of cost problems. I think TDOC has been much better at managing their profitability. So of the three that really have the potential to 20 bag or better, TDOC is probably the best of class. Open Door is the most interest rate sensitive, and Cardlytics is the most management sensitive. And they have a new CEO, but he was the former chief operating officer. So is he really a new CEO, or is he just going to do the same crap that they've done in the past?
Not really.
So maybe he's going to solve their problems, but I'm highly suspicious of Cardlytics' new CEO that was the past chief operating officer, because how much of a fresh pair of eyes and a fresh action plan he's going to have. Now, maybe it could have been that their problems were really based on the old CEO, and it also could be that they've solved a lot of problems. It just takes time to show up. I have a position in Cardlytics because the potential is so huge, but I think what I want to be buying right now is TDOC. Maybe a couple other things.
Yeah, I don't disagree. TDOC, Burford, both seem, and NRDY.
Yeah.
All those seem like really good buys to me. Oh, there's another chart that we didn't talk about, TWI.
Oh, yeah. That's my industrial with the new John Deere contract. Let me go into
this might be something that I look to enter soon, because this is, just playing out perfectly.
Yeah.
It, bounced off that bottom it created at around 6.5. It's holding above the two moving averages. It's about to make a golden cross, coming down from overbought. This looks like it's ready to run.
Yeah, and there's so many nice little small industrials out there that great things are happening to the company, and if they have a good secular environment, they're going to do amazing. And Titan International, I think, is going to do fine even without that. They just landed a great contract for John Deere to be the global supplier. So the stock sold off on an acquisition. And the acquisition, they didn't even overpay for it. So they got the acquisition. They, for one thing, they paid in stock, and they weren't an aggressive share buyback company before that, but they want to kind of sterilize the stock they used for the acquisition. And the price collapsed so much after the acquisition. They've essentially bought the company they acquired, I think, for 3.5 times EBITDA. And then the stock price gets cut in half. They end up for cash out the door after they buy back the shares. They're buying the company for like less than 2 times EBITDA. And if you look at the offerings in the different segments, it's like they had best-in-class offerings for half the market, and the company they acquired had best-in-class offerings for the other half of the market. And that allows them to now acquire this huge John Deere contract to be their global supplier, because now they can have a complete offering. So I think TWI is doing a really good job. And they had some crazy action here because the original founder started talking about getting military contracts again, like this company had in the past 20 years ago. And it was total speculation. There's like nothing in the works for it. The market, I guess the algorithms read new contract in Twitter, and they built that into the price, and then it sold off, and people realized it was just the founder talking things that he shouldn't have. But there's real good fundamental things happening under the surface for this one.
Yeah, the one thing that does concern me about the technicals is the MACD. We start to see that histogram going negative, and it's curling over. So maybe there'll be a better price to buy this one at. But kind of the same thing we were saying about TDOC and all the others. It's only a matter of cents. Do you get the stock 50 cents cheaper, or at the current price? Sometimes you don't get the option to buy it for 50 cents cheaper. It just keeps running.
Yeah.
So this one also might have like a small pullback, but I think everything else about it is looking pretty bullish.
Yeah. Well, we've been talking for a little over an hour. We've gone through most of the themes that I have on my pinned Substack model portfolio, and everything I'm seeing about this market right now, I just value is not where it's at. It's all about small tech. In fact, let me see if I can pull up the Morningstar style box, if that's confirming that and this doesn't have a nice year-to-date one, but this one still has large growth in 1 month. 3 months, 3 months it all still says large growth. So maybe it's a more short-term phenomenon that if I go to maybe here, right? That again the Magnificent Seven, it's not a bad chart. Right, it's still a bull flag.
Take a look at Meta real quick, and it's just interesting thinking about how this over the last 20 days has been ripping, but the rest of the Mag 7 hasn't.
Yeah, well, I think that it goes back to the DeepSeek situation, because the narrative shifted from so Meta was suffering under, they were doing open source. So they were not going to play the game of doing their own proprietary, paywalled large language model. Instead, they were doing the open source route. They were trying to be cheap and efficient and open source it. And after the Singaporean hedge fund released DeepSeek as an open source model, and it was very good for China and very good for low cost, even though they were probably fibbing about the full cost, the narrative shifted to open source was the way to do it, and Meta was right all along. But 20 days without a red day is a new record for any of the Magnificent Seven. I think the previous record was 14 days. So this is a massive combo breaker. But so this is kind of off in the weeds. And I know, let me go to the stock bond correlation. Find the right image for this. So where's the long run? This is probably a good one. So ever since Alan Greenspan, stocks and bonds have been negatively correlated. But for most of the history of the stock market, they weren't. For most of the history of the stock market, stocks and bonds were positively correlated. And one of the consequences of this is autocorrelation. When you are in a period where stocks and bonds are positively correlated, you have higher autocorrelation. And autocorrelation is the idea that if the market was down yesterday, is it going to be down today? Well, positive autocorrelation is up yesterday means up today, and down yesterday means down today. The negative
creates more momentum chasing.
Yeah, more momentum. So the 20 years of negative stock bond correlation created the BTFD, the buy the dip phenomenon. But if we're going to stay in a sustained period of positive correlation between stocks and bonds, and that leads to higher autocorrelation, then you're going to see more things like value sell off for 14 days straight with no relief rally. You'll see things like Meta rally for 20 days straight with no red day in there, which again is reinforcing my desire. I want to buy some TDOC right now because I don't think I'm going to get a dip to buy.
Interesting. So that after all this analysis, that's what you're most interested in buying next week?
Maybe. I mean, talk me down. Well, that and Burford Capital, but talk me down from the ledge if you can. But if we're in a period, if the revenge of Cathie Wood is the theme that's going to play out for the rest of the year, which it looks like it will, we're in a period of higher autocorrelation. I don't know if we're going to get dips.
Yeah. I mean, everything has, I guess, except for Meta, has to pull back at some point. But I can't really talk you off the ledge too much on that one. I think fundamentally, the company's been improving. They have a plan in place. They're starting to make action on it. The stock chart is showing signs that it's starting to rally. It's showing signs of life, and maybe we could have gotten it $3 or $4 cheaper, but anchoring bias, right? Can't always let that hold you back from participating in further gains. And especially what you're saying about the autocorrelation and the momentum, I think it's definitely well positioned between small cap tech and resilient healthcare. Their revenue's been growing solid. So I'm not going to talk you off the ledge on that one, but just interesting to see where your mind's at with all of this.
Yeah, well, some of this stuff I'm kind of one of the reasons for these chats once in a while is I didn't. This is stuff that I studied in the PhD program in finance, but it's not stuff that was at the tip of my mind until we talked about it. So sometimes new ideas are generated in brainstorming, and I generally wasn't thinking that way until I looked at the TDOC chart, and I know the technicals say, oh well, it's getting overbought, but if we're in this period of positive stock bond correlation and high autocorrelation, I don't know. It could just keep on going.
Yeah, and the MACD is not showing any signs of letting up.
Look at 3 months. I mean, this is
it's at the top of its Bollinger Band and overbought. So I, just based off the volatility of this company, I might look at least for a dip to buy on. I always tend to prefer to buy on a down day rather than an up day. That might just be my own psychology, but yeah, it's definitely looking like it's breaking out, undeniably.
Yeah. Well, all right. Again, we've been chatting for more than an hour. Mitch, I really appreciate you coming along. It's a huge help for me to look at the sectors and to review the themes. And I think 2025, Cathie Wood is back, and I want to jump on that train and
Yeah,
ride it to its destination. But
I'm with you there, and thanks again for having me. It's always great to have these conversations.
all right, have a good one, Mitch, and thank you
All
guys
right,
for listening.